So first of all, I want to give you a little background on the Rural Zone program. It was signed into law May of 2017, and rural stands for Revitalizing Underdeveloped Rural Areas Legislation. And the purpose of it is to offer incentives to encourage the revitalization of rural downtown areas through job creation and business creation, as well as the rehab of historic buildings in the downtowns. The zones are going to be designated every year by the commissioners of the Georgia Department of Community Affairs, as well as the Commissioner of Economic Development. They make the final decision on these. They can designate up to 10 per year, and those designations began in 2018. The designation for the communities lasts for 5 years, and the first group of communities were announced in December of 2017, and the first group of 9 communities that were designated you see here, and the second group as well. So those are the communities that are our current rural zone communities, and our newest set of rural zone communities are seen here. So as I said, the commissioners can designate up to 10 per year. First and second year, they designated 9 each year, and then this past year, they designated 3, 4, 5, 6, 7 blight zone. This is the 2018 Rural Zone Annual Report results from these 9 communities that are listed at the top of the page. And these are some good numbers. For instance, the average vacancy rate in those 9 rural zone communities in 2017 was 26.1%. By the end of 2018, that had gone down to 18.6%. So we were seeing some movement there with businesses coming in and vacancy rates going down. 72 parcels were sold within those 9 rural zones over that calendar year 2018. 48 businesses were renovated within those 9 rural zones. And we had 42 new businesses created within those 9 rural zones and 195 jobs created. The total public investment made within those rural zones was $2.1 million, and total private investment made in calendar year 2018, $8.4 million. So some really good numbers that show the success of the program. And we'll be getting the 2019 numbers ready pretty soon. So the Rural Zone program goals are, as I said earlier, the purpose is to assist in revitalizing rural downtowns. We do this by offering incentives, and those incentives are 3 Georgia income tax credits, a job tax credit, an investment credit, and a rehab tax credit. And those are given for job creation, commercial investment, and business activities, and rehabbing of historic buildings within the designated rural zones. The job tax credit is the first credit we're going to be looking at. And so if a business decides to locate within your designated rural zone and creates at least 2 jobs, they can get $2,000 credit per new full-time equivalent job. So it's per FTE, and FTE means just simply an aggregate of employee hours working a total of 40 hours per week. So it's the equivalent of 1 full-time job. So let's say you have 2 part-time employees, each working 20 hours a week. That would be 40 hours total. So that would be 1 full-time equivalent for those 2 part-time jobs. The threshold is 2 jobs do have to be created, but of course it could be more depending on how many jobs you create. Eligible businesses that locate within your rural zone do have to be specific NAICS codes, but it's typically those kinds of businesses that you would want to see in your downtown. So, you know, at a law office, a doctor's office, a brew pub, a bed and breakfast, a gift shop, retail clothing shop, a cupcake shop, ice cream store, that kind of thing. What you would want to see in your downtown, those are going to be those eligible businesses. The credit cannot exceed $40,000 per year, but again, that's $2,000 per new full-time equivalent. If a business locates within your rural zone and creates 2 new jobs, or if an existing business within your designated rural zone creates an additional 2 jobs, they can also be eligible to take the tax credit. And the credit can be taken for 5 years as long as those jobs are maintained. And I actually learn better when I see examples. So I'm going to give you an example of this. Again, we want you to understand what the tax credits are because we want you to understand how it's going to be used and think about how you're going to promote it in your community when and if you do get designated. I think understanding the program really helps you better answer the questions on the application. And we have had applications come in where it was clear that the person putting together the application didn't understand the tax credit program. So we want you to understand that before you put together your application. So this is an example of the job tax credit. Let's say that two sisters decide to open a women's clothing boutique within the boundaries of Nashville's rural zone. So the two sisters are going to work 40 hours per week, and they are going to hire 4 high school students who each work 20 hours a week. So what's their tax credit? Over 5 years, if all of the jobs are maintained, first we've got to figure out how many jobs were created. So you've got the two sisters working 40 hours a week, so that's 80 hours. And then you've got the 4 part-time high school kids working 20 hours a week, so that's another 80 hours for a total of 160 hours worked. If we divide that by 40 hours, then we come up with 4 full-time equivalent jobs. And remember I said it's a $2,000 tax credit per job. So you've got 4 FTEs times $2,000 for the first year, that's $8,000, as well as for the next year, the next year, the next year, and the next year. For all 5 years, as long as those jobs are maintained, then the business can take a total of, over the 5-year period, a $40,000 tax credit. So we just went over the job tax credit. Now I'm going to talk about the investment tax credit. This would be equal to 25% of the purchase price of the building, not to exceed $125,000. So this is if, say, a developer comes in and purchases a building within your designated rural zone, he could take a tax credit for 25% of the purchase price. And when I say tax credit, I am talking about a Georgia income tax credit. For the investment tax credit and the rehab tax credit, there does have to be a business located within the investment property that creates at least 2 full-time jobs and maintains the employment for the 5 years. The example I gave was that an investor comes in and purchases a property. So let's say an investor comes in, purchases a property, rehabs it, and then leases out the space to a couple of different businesses. As long as those businesses create at least 2 jobs, the investor can take the investment tax credit. He himself does not necessarily have to create the jobs. And just as long as there are 2 FTEs located within the building. Here's an example of this. Developer purchases a 2-story, 25,000 square foot building located within the Toccoa rural zone for $400,000. His plans are to renovate the 2nd floor into 2 apartments, and the 1st floor will be leased out to a new law office with 2 full-time employees. So what's the amount of his investment tax credit? Well, he's got the 2 full-time jobs that he needs to be able to take it, and he spent $400,000 in purchasing the building, so 25% of $400,000 is $100,000. And what is the developer's investment tax credit over 5 years? As long as those 2 jobs are maintained, this tax credit has to be prorated over 5 years, so 5 into 100,000 is a $20,000 tax credit per year. This is going to be equal to 30% of qualified rehab costs, not to exceed $150,000. And by qualified rehab costs, we're talking about labor and material costs only. This credit has to be prorated over 3 installments over 3 taxable years. And the caveat with this is that the taxpayer cannot use the same rehab cost to generate any additional state income tax credits. So for instance, the Historic Preservation Division's state income tax credit for rehabilitated historic property, you cannot double dip. However, let's say the developer is moving forward with an application for federal historic preservation tax credits. That's fine. They can use the same rehab cost for that, but that's going to be federal, but not with the state income tax credit. Here's an example of the rehab tax credit at work. So same scenario as before, where the local developer purchases a 2-story, 25,000 square foot building located within the Toccoa rural zone, and he's going to spend $150,000 on the upstairs, $150,000 on the first floor and front facade. Again, he's going to lease it out to a law office that's going to have the 2 full-time employees. So what's the amount of his rehab tax credit? Well, again, we know a law office is an eligible NAICS code. We know that this building is located within our rural zone, and we know that they've created at least 2 FTEs, so he can move forward. He spent a total of $300,000 on his rehab costs, so 30% of that is going to be a $90,000 credit. Again, that's going to be prorated equally over 3 years, so $30,000 a year, and that's the rehab tax credit. Any questions on that program? If a business, one of the questions is, if a business closes after year 2, for example, does a business have to repay those tax credits that they received? Believe the answer to that is no, they do not. But they would not get any additional credits. And because the numbers are prorated, they would not get the total amount. They would only get the amount for the first 2 years. Susan, I hope that answers your question. Don said, can an investor stack the investment credit and the rehab credits? Very good question. Yes, I should have said that. An investor can stack the investment credit, the rehab credit, and the job tax credit. They can stack all 3. Again, as long as those jobs are created, they can stack all 3. Is a building that was purchased prior to the rural zone designation with rehab, let me open this up. Is a building that was purchased prior to the rural zone designation with rehab starting after the designation eligible for the rehab credit? Yes. So they would not be eligible for the investment credit because the purchase was made prior to the rural zone designation, but they would be eligible for the rehab credit as long as they're able to create the 2 full-time equivalent jobs. Good question.